Yeah, so as many people know, we work with a diverse range of investors, ranging from people who know very little about commercial real estate and are investing, let's say, $50,000 at a time, and they're just a high net worth individual, then ranging up to smaller fund managers or fund of funds, co-GP partners, family offices, private equity firms, JV partners, kind of the whole spectrum. And something that we've all learned working with a very diverse group like that is you really get to know the way that different partners work. Some are very relationship driven and they want to meet you in person, shake your hand, get to know you, and they're really investing in the jockey. And then others are wanting to just dive into the numbers and underwrite the deal a million times and ask a million questions. And everyone's got their different style, which is perfectly valid. One thing that's interesting about the difference between more institutional investors versus call it retail is the kind of the lead time and the way that the deal changes. That's what I want to focus on, because we all know that when you originally spot a deal out in the wild and you go tour it for the first time, you underwrite it for the first time, you get it under LOI, then you go under contract, then you do due diligence when you're under contract. All the while, interest rates are going up and down, and the Fed's saying this, the Fed's saying that, and there's just so much that happens throughout this whole period. So we all know that deals can change dramatically from the time that you first lay eyes on them to when you actually close. And when I say we all know, we all may know it, but frankly, JV investors they get it and they're in the business, so they're more accustomed and comfortable to change, whereas change can really rattle and throw off more retail investors or passive investors who aren't really in the business day in and day out. And unfortunately, those types of investors can perceive change to be risk.